Okay guys, so I have now been trading for around 5 years. I started trading in 2019, and back then I was a 16-year-old, I was going to college, and I basically saw trading as a way to make a lot of money. Obviously, that didn't happen very quickly, and over the years of trading, I have learned a lot of lessons. I've learned the good sides of trading, I've also learned about the bad sides of trading. So in this video, I'm going to talk about both of those aspects of trading. I'm going to give you one lesson for each year that I've actually been trading, something I learned in that year that helped me progress into the next level as I was going along my journey. It obviously wasn't as simple as start in 2019 and then in 2020 have millions and millions of pounds. Obviously that was not the case. I wish it was, but I also feel like having a journey where it hasn't been easy is very key. And it also grows you as a person and as a trader. So a brief introduction of how I actually got into trading. Maybe there are some new viewers watching that haven't previously watched the videos where I go over how I actually got into trading. I basically had someone at the school I was attending. They knew about trading, they were trading, they had like a trading Instagram profile. And that's kind of where I first realized that, okay, you can trade the financial markets. I thought traders just traded stocks and everything back then, but I saw this and they were living the trader lifestyle, the typical lifestyle. And obviously I wanted a piece of that. I was a teenager, I want that lifestyle. That's just what every teenager thinks, or mainly I thought like that. So I obviously got in touch with him, and obviously I was just funneled into a paid group and, broker sign ups, signals and everything like that, which wasn't great. But it also did mean that later down the line, I didn't fall for that again. I'm not saying it's like a scam or anything, but it's not the best way to actually learn how to trade. People will get you into a group that maybe they don't even know how to trade, but because they have got a broker sign up link, they're making hundreds and hundreds of dollars just for you signing up with their group. And also if they then send you losing trades, they get commission on those losing trades from the broker. So you do have to be very, very careful. So in my first year, the main topic of year one is risk management. And a lot of people don't want to hear it. You probably want me to say, okay, this is how I made so much money. This is how I flipped my accounts. But that is not the point of this video. This video is to help you progress as a trader, not to teach you how to over leverage your account. And I'm going to talk about risk management in detail now. What happened to my first accounts, what actually happened after I learned about risk management, and how I actually went about learning about it. Just like everybody else, when I started trading, I just wanted to get as rich as possible as soon as humanly possible when I first started. This is obviously the wrong path to go down. And if you are a trader, majority of people watching this video have either traded or are traders. You will know that this is not possible. And you will also know that the more time you spend trying to do that, the worse it's going to get. It's almost like gambling. You put £100 into an account, you try and flip it to 1k. That fails, okay. Think in your head, okay, I know what I did wrong. Price is dropping now and I was buying, so maybe I'll just sell now. Okay, so you put another £100 in, gone again. Now you're down 200. Obviously, you could do this 5-6 times and it would work once and you are profitable, but that's not the way you want to trade. You're basically going in knowing that there's a 50-50 chance that your whole account is gone or you make a lot of money. It's the exact same at gambling. And the reason I actually thought this was sustainable was because of these traders online. They were doing account flips on their phone. They were making £10 to 1,000 in a week and everything like this. And obviously these things are possible, but it's not something that should be promoted. You shouldn't be saying, okay, buy my course and you can flip 10 to 10k in a week. Obviously it is possible. I've done account flips like that. But if you are marketing that as your main way of trading, then that can be quite dangerous for the people watching your videos. And the people that are actually doing it know this, but they know it gets the clicks. So I obviously went about my trading, and if I can find some old screenshots of my broker statements back then, I will put them on the screen, because it was bad. It was very, very bad. I just deposit 100, lose it, deposit 100, lose it, deposit 100, lose it. And I was lucky at the time that I was actually making money through buying and selling clothes. So I buy like high-end designer clothes, mainly coats and jumpers and stuff like that. Like Canada Goose, Montclair, those sort of brands, and I would buy them cheap and then sell them. So I was actually making a decent amount of money for my age. Basically, that was all just going into trading, those flip deposits, which eventually I got out of. The main reason I got out of that was because I realized that I'm never going to actually become a trader if I'm losing the whole account in a couple of days every single time. A lot of people watching this video can probably resonate with that. You've tried to flip your accounts. You try to put in a little amount of money and flip it into a large amount. And this is not the way to go about it. You need to learn correctly about risk management. And I feel like the best way to actually learn about risk management sometimes is through taking big losses. Obviously, if you can avoid that, then it is 10 times better, because it means you save a lot of money, you save a lot of stress, and you can kind of skip a few steps that most people unfortunately can't skip because of the way they actually got into trading. But let's say this is the first trading video you've actually seen, or one of the first. You've only been trading for a few weeks. Maybe you're on a demo account still. That is very, very good, because I'm going to emphasize to you, use proper risk management. Learn proper risk management. There's a difference between learning proper risk management and using proper risk management. You could probably Google what risks you use in trading. It'll come up with the generic 1% risk per trade, and that'd be fine. But it's much more in depth than that if you actually want to make money and if you actually want to preserve your capital, which is, again, the most important part in trading. We all want to obviously make profits, but the main goal is to not lose money. You know, you're doing better than 90% of traders if your account balance is the same now as it was a year ago. Although you haven't made money, you're still doing better than 90% of people. I do feel like getting this stage of my trading out of the way very, very early was a good thing. It got that, degenerate trading, so to speak, out of my system very, very early. A lot of people, they'll maybe skip that and then they'll make a little bit of profit and then go into it. But I had it from right at the start of my journey. So I knew straight away, okay, I need to sort this out. I need to risk manage correctly. So the way I actually went about this was through testing. If you do backtesting, for example, and you trade the exact same as you would be trading on live, but you're testing previous data, you'll soon see the risk that you should be using. Let's say, for example, you're backtesting and you implement the same risk you've been using on a live account. 5, 10%, 20% risk, like a lot of beginners actually use, not knowing how high that actually is. You'll quickly see 5, 6 losing trades in a row, your account's down 70, 80, 90%, maybe even the whole account is gone. And would you be okay with that? Anyone can hit a losing streak at any time. You could lose 5 trades in a row next week. Would you be prepared to lose your whole account? And when I actually thought about this, I was like, actually, I don't want to lose my whole account. I want to be, a sustainable trader. I don't want to lose my money and just be gone. I don't want my account to be gone. So I feel like learning the basics of, okay, risk 1% per trade or 0.5% risk per trade. This is a good overall basis, because I see a lot of people go in with 10 lots, 50 lots, 100 lots on every single position. It's like, how are you even managing your risk if that is the case? I often get DMs on Instagram saying, I have a 50k account, what lot size should I use? Firstly, I don't know what pair you're trading. I don't know your stop loss size. I don't know your losing streaks. All these things have to be taken into account if you want to know what lot size to use. You definitely can't ask somebody else what lot size you should be using. And if this is a question you've been asking people, then you need to do your own research. You need to find a lot size calculator, for example. This would be a good start. You can type in, okay, I'm trading GBP USD. I have a 10 pip stop loss. My account balance is £10,000. Then it will give you your lot size. Also, you need to know how much you're going to risk before you enter the trade. This sounds quite simple because you put in the lot size before you enter the trade. Now it's quite simple, but you need to have a set stop loss, because if you go into a trade without a stop loss, yeah, you have a lot size in mind and you've obviously placed that lot size when you've pressed enter on the trade, but you don't have a stop loss. So when you actually going to close the trade, how do you know when to get out of the trade? You don't know how much you're going to lose if you don't have a stop loss. Obviously, you could do a mental stop loss, and this can be quite dangerous because slippage, you could have a big push with momentum, you could lose connection on your phone. These are all things that you don't really want to play around with, especially when your money is on the line. And this is kind of something that emphasized it for me. I was looking, obviously, when I was 16, how much would I be earning per hour at a job? So at that age in the UK, you earn around £5 per hour. That's kind of like the minimum wage, I'm pretty sure. Every time I was losing £100 in a day from trading, I put it into perspective. That would have been 20 hours of work that I would have had to do at that time to make that £100. So by taking a bad trade, I just lost 20 hours of work. So 20 hours in a kitchen, cleaning, gone, because I over-risked on that trade. So I feel like putting the money into perspective, because sometimes it is very, very hard. You're just seeing numbers on a screen. Yeah, the numbers are big, they're going up and down. Obviously, it's relative to your income and everything. But you also need to realize that if that cash was on the table, would you be willing to just throw it away, burn it, if this trade loses? Probably not. But let's say you have a stack of 100k in cash, and every loss is 1,000 that goes, but every win is 3,000, for example. You'd be more inclined to take the trades and risk that amount. Whereas if 10-20% of that cash was gone on every single trade, you're less likely to take the trade and risk that amount. This is definitely something you should actually be interested in and kind of like visualize it when you are actually trading. What would your thought process be? Would you think the same? Would you take the same trades? Would you risk the same amount? And these are things that can definitely change your trading for the better, rather than just seeing, okay, it's a £100 account, I don't really care that much. It's a very, very bad mindset to actually have. I do go into a lot of more detail in my mentorship about risk management and how I use my scaling plans, like how I calculate my risk to reward, lot sizes and everything like this. Because to go in more detail, you could talk for hours about risk management. And coming up in 60 Profit, my new company that's launching very, very soon, hopefully, we have a full section about risk management. So be sure to check that out. 60 Profit link in the description. It's going to be the best risk management video you've ever seen, and a full week of risk management content. But I feel like if you are struggling with risk management, if you are struggling with trading real money, just lower your risk. Lower it to 0.5% or 0.25%, because at least then, if you do lose, you're not losing a lot of money. 0.5%, even if it's a 100k account, relative to the account size, it won't look like a lot. $500. It's obviously still a lot of money, but relative, it's not as bad. And if you're used to taking 1k, 2k, 3k losses, now just losing $500, it's going to be a lot easier to manage your emotions and ultimately handle your losses, which is a big part of risk management. People often think risk management is just being able to pick a lot size on that trade. That's not risk management. It's obviously an aspect of risk management, but handling losses, trading through drawdown, trading through winning periods, this is obviously a part of risk management too. And in some cases, for a lot of traders, it can be much more important than just picking a lot size and risking 1%. But people don't understand this. The more disciplined you are outside of trading, the more disciplined you are going to be with risk management. The more time you put into understanding your strategy and understanding what you can actually risk and have a profitable strategy, which is very, very important, the more money you'll make. It's literally as simple as that. So later in the video, when I'm going to talk about different ways to actually improve your strategy, this will also include risk management. But right now, the main thing you should focus on in risk management is understanding your strategy, understanding how much you can risk and be okay with hitting a losing streak. How can you manage that losing streak and get out of drawdown as quickly as possible while still maintaining the same strategy, the same plan, and trading as you normally would? These are very, very important factors. So those are a few things I actually learned about risk management, and I hope you learned something. But now we're going to move on to the next point and the second year of my trading journey. Okay, so let's assume you now have done your research on risk management, and maybe you have a better understanding of the importance of risking the right amount on every single trade. Year 2 was when I emphasized backtesting a lot. And when I say a lot, I mean hours and hours every single day. I was a college dropout. I didn't have anything else to do. So I was just trading, backtesting every single day for as long as I could. I feel like a lot of traders say, okay, less is more. You don't want to be on the charts a lot. But I feel like that's true with live trading once you get to a certain point. Like now, the more time I spend on the charts, it doesn't mean I'm going to make any more money. But when you're learning to trade, I feel like experience is very, very important, especially with historical data, i.e. backtesting. The reason why I think backtesting is probably the best way to build a strategy is because you have access to years and years of data at a click of a button. If you're using tools such as FX Replay, there's an affiliate link down below. It's probably the best backtesting tool on the market. You can literally see so many different stats and you can trade on historical data. So you're going back in time a couple of years and you're still actively trading. You can see the account balance, what you'd be like after the first 6 months, the first year, the first 2 or 3 years of any particular strategy you are looking to trade. Why is backtesting so important? And why should every single person, whether you're profitable, not profitable, just getting into trading, why is it important for every single level of trader? And I feel like this is because backtesting, you can pretty much test absolutely everything, whether it be your risk to reward, which is something that I implement very, very heavily. And that's what I emphasize in and that is also something I emphasize in my mentorship, risk to reward testing. The main reason why I actually do this is because let's say you're entering a trade and you just want to 1 to 5 risk to reward, let's just do this, or 1 to 3 risk to reward, let's just do this. It doesn't really make sense. People often ask me why I do 1 to 3 risk to rewards and not just based on the highs and lows of previous price. And the reason is I've done my testing on my risk to reward, and 1 to 3, if I have a winning trade, that's the one that gets hit. And it could go further. It could go to a 1 to 5 or 1 to 7. The percentage of times that it actually does is very, very slim. So I'm not going to hold out for that long. You could also take it another way and say, okay, so 1 to 3s get hit this percentage of the time, but 1 to 5s get hit this percentage of the time. Maybe I'll take partials at a 1 to 3 and take 75% of the position off, and then hold out the other 25% for that 1 to 5. Worst case scenario, maybe that goes to break even or that goes to a small loss. You're still making a lot of profit, even on a break even or a losing trade, if you know what I'm saying. So the beauty of using tools such as FX Replay is you don't have to know a lot of formulas in Excel. Prior to these softwares existing, you'd have to know all the formulas in Excel. You'd have to create a whole document, write down every single entry, every trade, and it's just a lot more complicated than using softwares. So by having something where it isn't all in one, it can be a lot easier for the average trader to find out about their strategy, that someone that isn't, a tech god, so to speak. Back when I was backtesting in 2019, 2020, 2021 even, quite heavily, I just used spreadsheets. I'd use Excel. I'd have to make it so that I could actually find out all the data I needed, had to work out how to use all the formulas. And obviously it's effective because it obviously worked, because I'm still here now 5 years later. But if I had FX Replay or a similar tool back then, it would have been 10 times easier. I would have known a lot more about my strategy because, there wasn't really a lot of information out there at that point. It was quite limiting what I could actually do with my knowledge of Excel spreadsheets, for example, like I previously mentioned. And the main reason why I actually use a software for it now is because I can see a year's worth of results of actual trading. So the backtesting tools, you can obviously just use TradingView, and this is good because it has the replay mode, but a lot of these tools now, they actually allow you to trade. So obviously it's not actually trading because you're not waiting hours and hours and hours. You obviously click through the candles, then you can actually trade. You can't go back and be like, oh, I would have actually taken this trade, because a lot of people, when they are backtesting with no trading aspect of it, they'll put a risk reward tool on, be like, I don't know if I was going to take this or not. It'll go to stop loss, and then in their mind they'd say, actually no, I wouldn't have taken this. So they don't put it down in their plan. So that means that in real life, would they have taken it? Would they have not taken it? You never really know. But if you are actually entering, boom, risk this, risk that, and every single trade whilst you're actually backtesting, you can get a good idea of, okay, I would have actually taken this trade, I wouldn't have actually taken this trade. So it is a very, very realistic set of results that you will actually have at the end of your backtesting session. And you can simulate for bad periods. Periods of drawdown, you know what to expect. If you have 2-3 years of data on this exact strategy, of the exact steps you're going to take when you're actually trading live, you know what your average drawdown is going to be. You know what your max drawdown is going to be. So you know how much to risk according to this. You also know when to increase your risk because you're winning more. If you know that a winning streak is about to happen, or based on previous data, you're likely to have a winning streak of this many trades on average, you know that you can increase your risk to maximize on these winning streaks. And obviously, if you didn't have the data on this, you wouldn't know when to scale in. You wouldn't know when to increase risk. You wouldn't know when to reduce risk, which is very, very important if you want to maximize the profits you're actually making on the strategy. A strategy that can make 10% per year, if you understand the drawdown and the winning periods, you can make that 15-20% in a year, just by maximizing on these different stats that you learn from backtesting. One of the main ways I use backtesting is for refining my entries. So I look at my setups that I've previously taken, and maybe there's something that I'm getting in slightly early on a majority of my trades, or my losing trades, they have a certain tendency to get me in the trade early, goes to stop loss, and maybe drops to the take profit. Maybe there's something you can see, and because you have all the data, maybe you're screenshotting every single trade, which is what I advise for you to do, because then you can quickly look back and look at the screenshots of the winners, look at the screenshots of the losers, and if it's all in one place, it's very, very easy for you to notice patterns just by clicking through. Okay, what happened on this one? What about this win? What about this loss? Is there any difference? Obviously, you're trading the same strategy, but there might be a difference in the way you're getting into the trade, or the candle, or the wicks. These are things you actually need to understand. And one of the main reasons why I think backtesting is amazing for the majority of people is because it can build a lot of confidence. I go into the markets now, I'm happy to risk $1,000, $2,000 on a trade because I know that my strategy is profitable. I know that over the past 3 years it's worked. So why would I not be confident going into the markets now? This does cure, well I say cure, but this helps with fear of entry. So people that are scared to get into the trade, they don't want to risk a certain amount, they're scared of losing money. If you have confidence in your strategy because you've seen it work over the past couple of years, why would you not get in the trade? You know it works. You have data to back it up that it does work. So why would you not get into the trade? Why would you not be happy to risk a bit of capital? If you're not following your plan, then that makes sense. But if you are following your plan that has previously worked perfectly, you have no other reason to not get in that trade. Maybe you're just scared. Maybe you just aren't cut out for trading. Maybe that is just what it is. And this kind of brings us on to the last point on backtesting. You can find out relatively quickly if a strategy is worth taking into live testing or live trading. Let's say you're just live testing a strategy, which could take months, if not years. It can be very, very time consuming and a waste of time if it ends up not working. Whereas if you put in the hours of backtesting, you can see quite quickly if it's going to win, if it's going to lose in the long term. Mainly just from the performance over two years of data. In 2 years of data, you can collect that relatively quickly if you're doing it in an effective way. Obviously, it depends on your time frame, your frequency of trades. This is obviously a factor, but it wouldn't take you 6 months, 12 months, 18 months to actually collect this data. So you can see in a couple of weeks, maybe 2 years of data, perfectly fine. And then you can see if it's worth even taking into the live markets. It might not even be worth live testing if it just doesn't perform well and it's not a strategy that you'd be willing to risk your money on. So these are things you need to consider when you're backtesting, and hopefully my way of speaking about backtesting emphasizes the importance of it for your own trading. Okay, so year 3, simplicity is key. And that's the title. That's all you should really know about trading. Simplicity is key. The more simple your strategy is, the easier it is to replicate and duplicate day after day, the better your trading will be. It's as simple as that. Let's say someone, trader A, has a very, very complicated strategy. They have to go through 6 different time frames, 5 different pairs. They have to have correlation on the dollar index. They then have to have multiple different entry criteria. This is quite a complex strategy. Are they going to be able to trade that effectively, at 100% every single day, every single time they look at the charts? The likelihood of that happening is not very high. But trader B, for example, trader B has a very, very simple strategy. They have one pair, they trade with one time frame, they trade one setup and one entry model. It's a lot easier for trader B to look at the charts and realize there's not a setup today. I can go off the charts, I can go play tennis, I can go on a walk, I can do whatever I want. There's no setup. I would always want to be trader B. Even if trader A made more money, their strategy was twice as good, I just wouldn't want that way of trading. And I used to trade in a similar fashion. I used to trade gold, I used to have different time frames, I used to have different entries. And yes, I made a lot more profit, but it wasn't the trading that I wanted to actually do. It wasn't the lifestyle that I wanted to live. I was having to trade every single session, multiple trades per day, missing setups because, there was something I missed on the charts. This isn't something that I wanted to be doing. So what I did was I narrowed it down to one pair, which was GBP USD. I had one time frame, which is the 15-minute time frame. I had one setup, which is my strategy, obviously. Mentorship link in the description if you do want to learn it. And it just made it a lot more simple. I always preach simplicity is key. The way I look at a simple strategy is very, very simple. If I open the charts in the morning, within 5 minutes, probably even less, within a matter of seconds, I can see if there's going to be a setup. The main reason behind this is there is one thing I really need to see for a trade to be valid, and this is a break of structure. If there's no break of structure, or there's not going to be a break of structure, and by saying going to be a break of structure, price is nearing a previous structure point. If that is not the case, I don't want to be in a trade. I don't want to be spending my time staring at the charts, looking for something that just isn't going to happen. If I know exactly what I want to see, and there's a few points that I need to see, and it's on one pair, one time frame, I'd have to flick through multiple to even see if it's there. You know, it can take me a couple of minutes per day. Obviously, if you're in a trade and there is a valid setup, it can be more time. Even with a simple strategy, you have to have a valid entry. You then might have to manage your position, and at key points in the markets, it still won't take that long in comparison to someone that is, trading a very, very complex strategy. You often see nowadays traders come out with these ridiculous names for their strategy. It all boils down to the same sort of thing. It's probably support and resistance, or supply and demand, or a trend-based strategy, or they trade during consolidation. Like all these things, they have like the ZQ block, they have the blah 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 breaker structure. Like, you just need to realize that these people, they'll sell you these complex strategies to make it seem like they know more than the other traders. Whereas support and resistance traders, they make money. Indicator traders, they make money. SMC traders, can't say the same for those, but maybe some make money. But the simplicity is key. I've noticed that when I was during this phase in my trading a couple of years ago, I saw, Wyckoff, SMC, all this rubbish, and I saw it and was like, okay, this seems quite complex. Maybe it's actually better. Maybe I can just win more trades. But I looked into it further and I realized that my simple strategy was so much easier to trade. And if you have a strategy that's easy to trade, and it feels like when you open the charts, I only have to look for a few minutes and I can trade. What is not to love? What is not to love about a strategy or a job where you can look for a few minutes and know if you even have to go to work today? That's kind of the way I look at it. Within a few seconds, 20 seconds, 30 seconds, I know whether I have to go to work. And going to work as a trader is obviously executing trades, managing positions, and then journaling afterwards. That is going to work as a trader from my point of view. And if I have a simple strategy, I know whether that is the case or not within seconds. And I am going to keep this section short because I've said it. Simplicity is key. That's all you really need to know. So let's move on to year number 4. So year number 4, this is kind of the year where I focused on prop firms. Prop firms are still a good way of making money. There's not a single thing I would say really bad about prop firms and my experiences with them. Obviously there are a couple of issues, but that is usually firm specific. Like the actual idea of trading with prop firms, I don't really see any downside. So year 4 was when I focused on increasing capital, and mainly increasing trading capital. Because obviously by saying increasing capital, people probably think, oh, he's just trying to make more profit. But this is not the case. By increasing capital, I mean trading with large accounts. Probably will seem quite basic to some people, but a lot of people neglect the fact that you can be a better trader with larger accounts. I often see it online where people say, you can't trade a small account, you can't trade a large account. And yes, this is true. You can't manage £1,000, you can't manage 10,000. That is true. But I also think having a large account can also make you better. There's two types of people when it comes to this. Again, I'm going to use the trader A and trader B scenario. To trader A, for example, they have been doing quite well on their small account, £10,000 for example, and they think they're ready for a 200k account or a $1 million prop firm account. So they buy the challenge and all of a sudden they can't trade it. They're taking trades they wouldn't normally take. They're basically panicking. And this is because they jump in at the deep end. Obviously, if you are looking to trade higher capital, you're going to want to stagger and slowly go towards that higher capital. Maybe you go to 25k, then 50k, then 100k, then 200k, then 400k. You don't want to just jump in at 400k. This can be a disaster because the profits you're actually seeing, or even the losses in most cases, are 10 times, 20 times, 30 times as big as they were on your normal account that you're used to trading. So So it's going to obviously be difficult for you to handle these losses and maybe a losing streak if you're not used to these large accounts. But let's say trader B, they do go up the slow route. They go from 25k, 50k, 100k. Now their losses each time are only doubling. But they're now used to seeing $500, $1,000, $2,000 losses, but they haven't just jumped into $4,000 losses. They've slowly gone up from 100, 250, 500, 1,000. This is a very, very good way of actually doing it. This is something I actually did. A lot of people would think, oh, he's been making money for ages. He's probably just got $1 million in funding. But my first funded account was $25,000 back in 2021. So then obviously in 2022 and 2023 was when I focused on prop firms. But last year was my main prop firm focus. You'll probably see on the channel if you scroll back. I had 50k days, 30k days, number one on the leaderboard for multiple prop firms multiple times. And, you know, just through Forex funds alone, I think I had almost $100,000 in payouts just from that one firm. So obviously I know what I'm doing when it comes to prop firms, especially trading them, getting payouts, getting consistent payouts too. The main reason why I think prop firms actually improved my trading was because it emphasized the fact that small gains add up. And I tweet about this a lot, and I say that 2% per month and you're completely fine. You're set for life with 2% per month consistently, or on average. You'll often get the people comment, oh, I make 5% in a day, I make 10% in a month, 2% can't make you anything. You can't be a professional trader with 2% per month. But these people most likely aren't trading large accounts. And this is quite evident in the trading industry. You'll see people that expect to make 20%, 30% in a month, every single month, and act like if they don't, they're not a professional trader or they're not a good trader. I'm here to tell you that if you make 2% per month consistently, I would put you higher than someone that makes 20% a month sometimes and they expect to make it. Because 2% a month on a 400k account, 400k funded account, you're making over 6 figures in a year. Would you be happy with that? Most definitely. You kind of need to realize that it can be the capital that's holding you back to a certain extent. Traders on small accounts, they want to make the gains of the traders on large accounts. So what do? They increase their risk. They take extra trades. They force themselves to be in the markets more, thinking that they'll make more profit as a result of this. This is obviously not the case, but they don't see this, and they see it as more time in the markets, more risk, more money. It's not going to happen. But on a large account, 400k account, for example, if you're making 4% per month normally, you can now risk 0.5%. Then you're making 2% per month. Worst case scenario, you lose 4 trades in a month, you're down 2%. Big deal. But then if you win the trades, you can be up 2%, 3%, 4% with this low risk. You can make less percentage, make more profit. So you often see traders that maybe struggle trading prop firms, but are good on personal accounts because they make consistent profit, but they can't pass the prop firm challenges. But now that's not an issue. They have unlimited time. If you make 2% per month and you have low drawdown, maybe you could risk 2% and try and pass the prop firm. There are many different ways to actually pass these challenges and make profit. And I feel like if you are just neglecting them, then you are missing out on a lot of money. It's a lot more difficult now. I say 2022, 2023 was kind of the sweet spot for trading with prop firms, but now you can obviously still make money with them. There are still legit firms, notably FTMO, probably the biggest firm in the industry, and they always have been, and they probably will continue to be the biggest firm. And it is great to see a firm that people can rely on and trust that they're actually going to get their payout. That is just the beauty of it. So moving on to year number 5, and I'm currently in year number 5. So I'm going to talk about what I'm focusing on this year and kind of like a lesson this year. And that is personal accounts matter more than prop firms. And obviously I've been trading my personal accounts for multiple years. Now I think it is more important. The main reason is prop firms can be very, very risky. I've had it in the past where I've been up in profit tens of thousands and all of a sudden you break a rule. You break a rule that is very, very stupid. And then you don't get paid, or your payout gets rejected, or you just passed and you're going to get a payout and then the firm shuts down. This has happened to me multiple times. So imagine you spend all those hours trying to pass. You spend all those hours journaling your strategy, backtesting, to pass a prop firm, and then it shuts down, or they reject your payout. It's just not worth it. Whereas if you've been trading a personal account and compounding this the whole time, it doesn't really matter. Obviously it is annoying, it's frustrating, especially for a lot of people. Prop firms is their only way to make large amounts of profit from trading. And obviously in the previous lesson, I did say that having large capital is key. But if you choose the wrong firms, you're not going to get paid. It's literally that simple. So by focusing on your personal accounts as your main focus, is very, very good. I see a lot of traders that they'll end up trading with prop firms and their trading style is then adapted to prop firms and it just doesn't fit personal trading. Let me put this into perspective for you. You can be a losing trader but make money from prop firms. So let's say you failed 10 challenges. You're down $4,500, for example. And then you get one payout of 5%. That's 5K. You're now up $500. But from those failed challenges, let's say you lost 10% each time. You're down 100%. But then you get that 5% payout. You're now technically still minus 95%, but you've made profit. So then you go into your personal trading and realize, okay, I lost all these trades, I had these losing streaks, but I'm actually profitable. You know, they see themselves as a profitable trader. So they go back and, okay, I'm trading. The account goes down. They don't have that lifeline of just buying a new account and it resets to 100K. It doesn't work like that. So the traders that can't actually trade can still make money with prop firms. And it is very apparent that you'll see people that never trade personal accounts. What if that prop firm you're trading with shuts down? What if regulation comes in, it limits the leverage or it limits the payouts and everything like this? You're kind of stuck. You need to consistently be trading a personal account that has real money of your own in that account. You don't want to get out of trading live money. Prop firms are demo money. It resets just by buying a new account. You don't want to be stuck with that prop firm gambling, casino mindset. Because prop firms basically are a casino. They win most of the time. Some cases people get large payouts and do liquidate the firms, but that's a rare case. But you need to be focusing on your personal account and growing this alongside. The best way to do it is to funnel your prop firm profits into your personal account. So it kind of means that worst case scenario, or at least you've got money in your personal account and it is growing. But obviously the best way to do it is compound the personal account, then just use prop firms as an additional bit of income because you're taking the trades anyway. So if you did learn anything in this video, be sure to subscribe to the channel. Check out my mentorship if you are looking to learn how I trade, and I'll catch you guys in the next video.